Money doesn't disappear. It just quietly migrates to people who understand the rules. And if those rules feel unfair, that's only because no one taught you the game yet. But that's about to change. Fact 1. The corporation cloak. When you stop being you and start being a tax-efficient entity. Here's the first thing rich people learn. And no one ever tells you directly. Wealth isn't earned, it's structured. Normal people earn money as individuals. Rich people earn money as entities. Big difference. An individual gets taxed like a guilty suspect. A corporation? It gets treated like a VIP who always knows somebody at the door. Picture this. You're buying a laptop. As a regular person, that's just a purchase. As a corporation, that becomes a business expense. Suddenly deductible. Same laptop, same function, but one version magically lowers your taxable income while the other just lowers your bank balance. That's the entire game. If you don't understand it, you're playing with the difficulty set to suffer. Here's the real twist. Wealthy people don't necessarily pay less tax because they're rich. They pay less tax because they stop being a person the moment money arrives and start operating through a structure that does the heavy lifting and the tax slimming for them. The government taxes workers. It rewards owners. So the rich simply choose to be owners. Fact 2. The magic of depreciation. When your stuff gets older and your taxes get smaller. Here's a fun little trick wealthy people adore. They get rewarded for their assets getting older. Seriously, while you're out here crying because your car lost half its value the moment you drove it off the lot, a rich person is smiling because their assets losing value means they pay less tax this year. Depreciation is like the universe patting you on the back and saying, "Hey, I know your expensive thing is getting rusty. Here's a tax deduction for your emotional pain." But the wealthy take it further. They buy assets that not only make money, rental properties, equipment, vehicles, but also legally lose value on paper. Imagine buying an apartment that produces rental income every month, while simultaneously giving you paper losses the IRS happily accepts. It's financial alchemy. Real money in, fictional losses out. Meanwhile, regular people buy things that lose value but offer no deduction. The rich buy things that lose value and reduce their taxable income. It's not magic. It's knowing the rulebook everyone else ignores. Fact 3. The write-off wonderland, turning life into a business expense. Here's the real plot twist. The rich don't necessarily spend less, they just spend smarter. And by smarter, I mean they turn everyday life into a business deduction with the elegance of a magician pulling a rabbit out of a spreadsheet. Lunch, business meeting, flight, conference, laptop, work tool, phone, company line, training course, professional development, that fancy dinner, client relations, obviously. Regular people buy these things with after-tax money. Wealthy people buy them with pre-tax money, meaning the government essentially gives them a discount. You pay $1,000 and lose $1,000. They pay $1,000 and lose maybe $600 because the rest gets written off. The trick isn't cheating, it's aligning your spending with a business purpose. They structure their life so that life itself becomes part of the business. The rich don't ask, "Can I afford this?" They ask, "Can I justify this as a deductible?" Fact 4. The real estate tax portal, where cash flow is taxed like it's shy. Here's a secret rich people treat like a family heirloom. Real estate income isn't taxed the same as your paycheck, not even close. While job income gets hit fast, hard, and without mercy, real estate income strolls through the tax code like it owns the place. Why? Because rental income gets reduced by everything. Repairs, interest, insurance, maintenance, management fees, even that new paint job you convinced yourself was necessary for tenants. Add depreciation to the mix, and suddenly this asset is making money while looking broke on paper. The government smiles, the investor smiles, your paycheck cries. And here's the billionaire-style thinking. Real estate isn't just shelter, it's a tax strategy with a roof. Wealthy people buy the buildings, rent them out, and then let the tax code apologize to them for the inconvenience of owning something valuable. Workers pay taxes, properties pay owners. Guess who wins? Fact 5. The borrow don't sell strategy. When the rich live on loans instead of income. This one feels illegal, but somehow isn't. It's just outrageously clever. Rich people avoid selling their assets because selling triggers taxes, so instead they borrow against them. Stocks worth millions? Borrow. Real estate portfolio? Borrow. Business equity? Borrow. Why? Loans aren't income. Loans aren't taxed. The wealthy live on borrowed money at ridiculously low interest rates, while their assets keep growing untouched. It's like they found the cheat code where you spend money without ever having taxable income to punish. Imagine having 5 NIFRs in stocks. Instead of selling and paying taxes, you borrow $300K at a low rate, live your life, and let your portfolio grow faster than the loans cost. Your assets rise, your taxes don't. The IRS watches and shrugs because it's perfectly legal. The poor sell assets to survive. The rich keep assets and borrow to thrive. Fact 6. The tax loss harvesting trick: losing money on purpose. Here's a move that feels like 4D chess. Rich people turn their bad investments into tax discounts. While the average person panics and sells losing stocks out of fear, wealthy people sell losers. Strategically, not emotionally, to lower their taxable gains. Imagine losing $10,000 on a dumb investment. Normally, you cry and move on. A rich person? They smile politely and say, "Perfect. That loss will cancel out some gains. Bring me the paperwork." Then, and here's the power move, they often buy a similar asset right back, keeping their long-term strategy intact while locking in the tax deduction. It's financial aikido, using the market's punch to reduce your tax bill. Regular people lose money and feel pain. Rich people lose money and get rewarded for it. Fact 7. The residency. Shuffle, moving zip codes to shrink taxes. Middle-class people choose where to live based on schools, commute time, and whether the neighbors look friendly. Rich people choose based on tax codes. High earners move from California to Texas. Crypto guys flee New York for Florida. Entrepreneurs relocate offshore for better laws, better weather, and better accountants. Why? Because location isn't just lifestyle, it's a tax variable. State tax, wealth tax, capital gains rules, business incentives, it all changes the moment your legal residency changes. A wealthy person will happily move across the country to save 10% on taxes. That's millions saved over decades. Meanwhile, regular folks won't even switch banks because it's annoying. And here's the secret mindset. They don't ask, "Do I like this place?" They ask, "Is this place financially compatible with my goals?" Rich people vote with their feet, and their tax bill shrinks accordingly. Fact 8. The foundation play, turning charity into a tax strategy. Most people think the rich donate money because they're generous. Sometimes true, but often it's strategy dressed as generosity. Enter foundations and donor-advised funds, the tax-friendly vehicles where the wealthy park money, get a giant deduction today, and then decide what to do with the funds years later. It's like buying yourself reputation points, tax benefits, and public admiration all in one package. Even better, money inside these vehicles can grow tax-free, and the donors can still control how it's used. No rush, no pressure, just strategic philanthropy with a side of financial optimization. Meanwhile, the average person donates $50 and gets nothing. Not even a deduction anymore, thanks to standard deduction reforms. The rich donate strategically. Everyone else donates emotionally. Guess who saves more money doing it? Fact 9. The 1031 exchange, selling property without paying taxes like a financial Houdini. Here's a trick that feels like it should require a magic wand. Rich people sell real estate without paying taxes on the profit. It's called a 1031 exchange, and it works like this. Sell a property, take the profit. Instead of paying capital gains tax, you roll it into another property. The IRS basically says, "Oh, you're still investing? Cool. We'll tax you. Later." And later can mean never if you keep exchanging upward. Rich investors stack properties like Lego bricks. Each move bigger, smarter, tax-deferred. They keep swapping assets until their portfolio is massive and the tax bill is still sitting politely in the waiting room. And when they die, their heirs often get a step up in basis, wiping out the tax entirely. Regular people sell a home and get taxed. Rich people sell a home and upgrade, tax-free. Fact 10. The capital gains discount, getting paid less. On purpose. Here's the wild part. Wealthy people actually prefer not to earn income. Income is taxed aggressively. Capital gains? Much lower tax rate. So the rich engineer their earnings to show up as stock growth, real estate appreciation, business equity increases, not salaries, not hourly pay, not bonuses. They get paid in assets, watch them grow, then sell strategically at a lower rate, or not sell at all, using loans instead. Your paycheck hits your account and gets taxed immediately. Their wealth grows quietly and gets taxed softly or not at all. And when they do sell, they time it perfectly. Low-income years, specific tax brackets, election cycles, you name it. You earn money to live. They earn assets to reduce taxes. Fact 11. The family payroll, paying your kids instead of paying the IRS. Here's a move that sounds like a hack from a parenting manual written by an accountant. Rich people hire their own children, legally, strategically, and yes, profitably. Kids can work in the family business, get paid, and the parents get a tax deduction for the wages. The kid's income is taxed at a much lower rate, sometimes almost zero. Imagine shifting $12,000 from your tax-heavy income into your child's tax-light income, all while teaching them business skills, paying for their future, and reducing your IRS bill at the same time. Rich families do this for modeling, admin tasks, social media work, filing, simple office duties, anything legitimate. Meanwhile, regular families give kids an allowance. No tax benefit, no deduction, just vibes. The wealthy don't pay their kids allowance. They pay them tax-optimized wages. Fact 12. The home office play. Turning your living space into a tax shield. Most people see their home as a place to relax. Rich people? They see square footage and deductibility. When part of your home is used exclusively for business, office, studio, editing room, workshop, you can deduct a portion of utilities rent or mortgage interest, internet repairs, even cleaning costs. You're literally turning your home into a partial tax shelter just by working inside it. And here's the billionaire-style twist. Their home office often sits inside a giant mansion, meaning even a small percentage is worth thousands in deductions. Regular people pay full price for their home. Rich people write off part of their home as a business tool. If you work from home without taking deductions, congratulations, you're sponsoring the IRS. Fact 13. The R&D deduction, when trying new things becomes a tax strategy. Here's a fun reality. When normal people experiment, it's called a hobby. When rich people experiment, it's called research and development, and the government gives them a tax break for it. New software? Deductible. Prototype? Deductible. Testing a new product idea? Deductible. Paying smart people to think? Also deductible. Rich entrepreneurs run half their innovation budget through the R&D deduction, turning creativity into a tax-efficient activity. They try wild ideas knowing the government is subsidizing part of the risk. Even better, many of these innovations are simply improvements to what already exists. You don't need a lab coat or laser beams, just a business that constantly improves processes. The average person takes risks with after-tax dollars. The wealthy take risks with pre-tax dollars, dramatically lowering the cost of failure. When rich people fail, the IRS helps cover the bill. When regular people fail, the IRS sends them a reminder to pay. Fact 14. The retirement account. Overflow, using tax shelters like investment rockets. Here's something rich people do differently. They don't treat retirement accounts like someday money. They treat them like legal tax bunkers. 401ks, IRAs, SEP IRAs, solo 401ks, they use every account possible, max out contributions, and let tax-free or tax-deferred growth snowball for decades. Why? Because money that grows without taxes grows faster, a lot faster. Rich entrepreneurs will open a solo 401k, dump in 60K plus, and shelter income instantly. Investors stuff Roth IRAs with high-growth assets so future gains are tax-free. And the ultra-wealthy? They use backdoor and mega backdoor Roth strategies regular people don't even know exist. Meanwhile, the average worker contributes just enough to feel responsible, then stops. Wealthy people don't avoid taxes by accident. They use legal tax shelters like they're building a fortress. Fact 15. The insurance fortress, hiding wealth inside policies. The IRS can't touch, legally. This one is practically whispered in private wealth offices. Rich people use life insurance as a tax-free storage vault. Not the cheap kind you see in ads. I'm talking about sophisticated policies that grow money, Tax-deferred allow tax-free loans, avoid capital gains, pay out tax-free to heirs. It's wealth protection disguised as insurance. The rich stuff money into these policies, let it compound quietly, then borrow against them later, tax-free, just like they do with their investment portfolios. To the average person, life insurance is a safety net. To the wealthy, it's a multi-tool. Part bank, part investment. Part inheritance plan, part tax shelter. And the government? It treats insurance with velvet gloves because technically it's not an investment, even though the wealthy use it exactly like one. Rich people don't hide money in secret vaults. They hide it in plain sight, inside insurance contracts. Fact 16. The trust triangle, protecting wealth from taxes, courts, and chaos. Here's a secret whispered in expensive conference rooms. Money isn't truly yours until it's protected from everyone who wants a piece of it. Enter trusts, the wealthy family's favorite financial shield. A trust can reduce estate taxes, control how wealth is passed down, protect assets from lawsuits, keep family disputes from turning into reality TV, ensure the government gets the smallest slice possible. Rich people don't leave money to their kids directly. Too risky, too taxable, too stupid. Instead, they leave assets to a trust, which then feeds their heirs like a calm, tax-optimized vending machine. It's not about hiding money. It's about structuring it so nothing catastrophic can touch it. Regular people pass down problems. Rich people pass down trusts. Fact 17. The offshore efficiency play, using global rules without leaving the law. Let's clear this up. Offshore doesn't mean illegal. It means optimized. Wealthy people use international structures the same way frequent flyers use airport lounges, because it makes the journey smoother. Certain countries legally offer lower tax rates, zero capital gains, easier corporate rules, privacy protections, better banking environments. So the rich set up entities abroad, operate globally, and legally reduce their tax exposure. Meanwhile, regular people freak out about having to file taxes in 2 states. Imagine 2 countries. And here's the mindset shift. Wealthy people see the world as one big marketplace. Not borders, not hometown pride, just opportunity. While everyone else plays local, the wealthy play planetary. Fact 18. The step-up in basis trick. How wealth magically escapes taxes at death. This one feels like the final boss of the tax system. When rich people die, the tax bill for decades of gains often dies with them. It's called the step-up in basis. Let's say a wealthy person bought stocks for $200K that grew to $4 million. Normally, selling triggers huge taxes. But when they pass it to their heirs, the cost basis resets to $4 million, meaning all that growth becomes tax-free history. The family can sell instantly and owe nothing on all the appreciation. Years of growth erased with one line in the tax code. It's like the government saying, your wealth can stay, just you can't. Generational wealth isn't built. It's preserved through loopholes everyone else ignores. Money doesn't reward effort, it rewards understanding. So, which of these tax tricks are you finally ready to stop ignoring?